Welcome to Mandates and Megaphones, hosted by Jeremy Maggs, unpacking the politics, promises and power plays behind the G20 summit.
Hello and a warm welcome to Mandates and Megaphones here on Moneyweb in association with Standard Bank. Now, at the heart of the B20's work this year is the challenge of financing and building the infrastructure that drives growth. It is critical. And the recommendations presented late last week stress new models for investment, smarter partnerships between public and private sectors, and reforms to strengthen financial systems. But here's the question. Will these ideas be implemented, and can they make a real difference in fragile economies? Well, with me is Standard Bank Group Chief Executive Officer Tshabalala, who chairs the B20 Finance and Infrastructure Task Force. I'm Jeremy Maggs, and just for the record, we are recording this after the presentation of the document. So, Sim, a very warm welcome to you, and let's start with the big picture and key priorities. In your opinion, having presented this document, what is the single most important finance and infrastructure recommendation coming out of the B20 this year? In other words, what's your principal recommendation?
From a finance and infrastructure perspective, Jeremy, the single biggest recommendation is we need to close the gap between the amount of money necessary to put in place transformative infrastructure in the world, which is, the world spends about $3 trillion a year for that purpose. In the case of Africa, we need roughly $170 billion a year. The gap in the case of Africa is $85 billion. In other words, we can only raise 85 of that 170. And so the single biggest recommendation would be let us put together mechanisms that help us to bridge that gap. Perhaps in our conversation, we can break that down.
Well, let's look at some of those key mechanisms then. What is most important in kickstarting that process?
Jeremy, there are three broad things that the world needs to do. The first one is we need to put in place mechanisms that support transformative infrastructure. So in the case of Africa, it's roads, it's bridges, it's dams, it is data centers, it is giving people access to the electricity grid, it is distribution of electricity, it's transmission lines, and it's generation, whether it be fossil fuel driven or driven by solar and wind. The second set of recommendations that we will be making will be to say, well, we need to improve access to capital. Now, there are about $500 billion globally needed. In the case of Africa, 170, the gap is 85 billion. And so we need to make sure that we build investment capacity. We need to change the rules that make it possible for public, private, and philanthropic institutions, giving them the ability to advance money into these projects. And again, I'd like to come back to what those changing rules specifically entail to get money into these projects. And then the third thing that we need to do is we need to make sure that the flows of money from investors get into the real economy and find themselves into the hands of SMEs. Because what typically happens in these projects is that the investors put the money into the projects, but they only land in the hands of large corporations. So that third recommendation or set of recommendations suggests how you get the money right through the economy into the hands of SMEs. Perhaps we stop there.
Let's talk about the trickle down, which is critical, and also the rules, which are absolutely important. But how difficult is it to set priorities in terms of that big list that you've got? It's big, it's all encompassing.
In our case, perhaps I could give you an example of the experience of the conversations in this B20 process. I'm the chairman of the Finance and Infrastructure Task Force. My deputy is Nungisa Fuzile, who's the deputy for the purposes of this project. I've got 8 co-chairs. They come from throughout the world. Daniel Pinto, who's the vice chairman of JP Morgan Chase, Anne Richards, who is the CEO of Prudential, John Denton, who is the Secretary General of the International Chamber of Commerce based in Paris. And then we've got several other people, including Strive Masiwa, Terry Diu, Benjamin Hung based in Hong Kong. In addition to that 8 set of co-chairs who are deliberating in our forum, you've got 170 members of the task force, which participated in 4 sets of meetings which we chaired to deliberate on these issues. These people came from all over the world. The largest grouping actually came from South Africa. The second largest grouping came from the United States, then Zimbabwe, the United Kingdom, and so forth. And we met several times to narrow down the issues necessary to unlock that 3 trillion rand that I was referring to. And we arrived at a set of recommendations. In the area of, the cost of capital debate, how to get this money into these projects, we've made several recommendations, which you might want me to talk about, because that gives you an example of, firstly, how the debate happened and the concrete outcomes of those debates.
Well, lift the curtain as far as that's concerned. I'd be interested to know how those deliberations took place and how difficult it was to achieve the degree of consensus, because you want consensus, but you also want contestation.
Indeed. So the issue around cost of capital, which is very salient, and it's salient in this discussion because right here in South Africa, the ratings agencies are in South Africa reviewing South Africa. So I think it's a very, very important part of the discussion and the debate, the issue of cost of capital. Our contention has been that there's lots of evidence that these ratings agencies don't fully understand African countries. And as a result of that, they tend to assess them as riskier than they actually are. These are contention. We say that when you look at how they price African sovereign debt, the sovereign debt of South Africa, for example, we've shown statistically that their assessment of sub-Saharan issuers is often up to 4 risk grades worse than the levels implied by the fundamentals. So the economic fundamentals, the institutions, how the country works relative to the rating given is 4 times worse than it ought to be. In the case of South Africa, they rate us BB minus, junk status, whereas we're suggesting we should be BBB, which is investment grade. We've shown it statistically. And what we've been arguing to them, that if you were to rate South Africa as BBB, as I'm arguing, our sovereign spread, in other words, the interest rate that we pay effectively would be 50 to 70 basis points lower than it currently is. That would release, within a period of about 3 years, 50 billion rand a year. We would save 50 billion rand a year in interest costs for South Africa if that happened. So in our engagements, in our B20 task force, we've got the ratings agencies and we have engaged them in the process. We've had people differing in opinion. They've said, no, but the methodology works. Some have said, no, the methodology doesn't work. What's the data supporting that methodology works? What is the data that supports the technical structure of those models that they use? What are the inputs, debt to GDP ratios, etc.? What do they look at when they evaluate its governance? Do they use the World Bank governance indicators? If they do, we're saying, but they're often inaccurate. Those indicators, for example, rate South Africa very similar to Papua New Guinea. In which world is South Africa similarly rated to Papua New Guinea in terms of governance, the quality of institutions and so forth? And so we've persuaded people that this needs to be rethought, how the ratings agencies think. For example, they have been responsive as a consequence of some of these debates. They are now more represented on the African continent. In the case of Moody's, you saw that they bought an African-based ratings agency. S&P released a statement a couple of months ago saying that they were increasing their representation in South Africa, which is good. In that context, you've also said governments need to get their act together. Perhaps we might want to delve into what that means, but it's not just the ratings agencies that need to get their act together in terms of the cost of capital, as suggested in our recommendations. So must government.
Let me push you a little bit on the ratings agencies, because it's an interesting debate, and whether as far as any developing country is concerned, it's always going to be a debate between statistics and sentiment. And all too often, sentiment is going to trump the stats.
And
how do you overcome that?
So sadly, that's exactly the point. In one of the ratings agencies, if you use the statistics, the technical analysis, you get one rating. once they've done the evaluation, the human bits where people actually override what that evaluation does, they push us as South Africa 2 notches worse than what the statistics suggest. And that's based on how they view and what business people have been telling them about GDP growth. Where will the growth come from? How do they forecast what's going to happen? How do they think about issues around the rule of law, the relationship between the rule of law and GDP? So you're 100% correct. Sentiment actually makes a huge difference. And when the agencies come to the country, they spend a great deal of time talking to organs of civil society, to the bureaucracy, government, to business, and that sentiment makes a difference.
So you've raised a number of important issues, and I don't want to let them slide. One was the rules of engagement, the trickle down as far as SMEs are concerned, but I do like the point that you've made about governments getting their act together.
Yes.
So many countries have infrastructure master plans, yet few translate into shovels in the ground. How do you bridge that gap? How do governments need to get their act together in that respect?
Firstly, by clarifying the rules that relate to the management of monetary policy. Firstly, be sure that the monetary authorities are independent, as is the case in South Africa. There's a constitutional provision that protects their independence.
Always under attack, though.
Always under attack, but South Africa is a country of laws. And it's fantastic. As I've often said to you, Jeremy, we're an Athenian democracy with that beautiful constitution of ours, but it works. Secondly, making sure that the exchange rate reflects economic reality. In other words, it must float as opposed to being pegged, for example. Thirdly, there should be budget transparency. I'm proud as a South African to always say to people, hey, folks, over time, we are rated second, third, or fourth in the world for the quality of our budget transparency. And so we had the VAT spat, and you and I, and as was the case with everybody, were very depressed. But the outcome and the process actually showed the strength of our democracy. It actually showed that we are a country that is shifting from a classic Westminster system to a system more similar to what you have in the United States, but something in between. And that you cannot conduct budget planning and fiscal planning on the basis that you're a Westminster system. You're now in a coalition, for example, in the case of South Africa. So budget transparency, being clear about a fiscal rectitude, sticking to your budget plans. In our case in South Africa, we need fiscal consolidation, making sure that you include as much of the informal economy as possible. Collect your taxes. And then on the softer side, make sure that you are transparent with your investors. Make sure that you've got investor programs that manage investor relations. Give investors the right information, as South Africa does, for example. I know, and I'll go back to the point I've made, I know for a fact that there are a couple of ratings agencies in town over this period because they're reviewing South Africa's credit worthiness. And it is our earnest hope that then, having spent time with the authorities, with government, with the central bank, with organs of civil society, and with business, that they will upgrade us because the data suggests that they should.
Transparency is one thing, but any developing economy, South Africa included, need regulatory reforms to unlock new investment flows. To what extent did the B20 and your particular division or your particular area of interest apply its mind to that?
We did. We spent a great deal of time on that. And again, I'll go back to the ones that are closest to the industry that I work in. So we've suggested and we argue that in the case of South Africa, for example, that the United States, as I said earlier, is not implementing Basel IV. So you remember there's Basel 1, 2, and 3, and at the moment there's a debate around elements of what is called Basel IV. We've said, while South Africa can implement Basel IV, the United States and other countries haven't, and perhaps some thought should be given to us not doing the same, because all that does is it adds to the regulatory burden in emerging markets and in South Africa. And we want to reduce that regulatory burden. That's the one thing. The second one is we've said, but please change the rules that determine how much capital you hold as a bank or an insurance company to protect your depositors or your bondholders against the risks that you're taking in the projects that you are investing in. So please reduce that capital, because the capital we hold, there's a surfeit, it's too much. And we're saying, please change the rules that relate to that. The third set is, please also change the rules that determine how much capital you need to hold when you have a guarantee, for example, from a multilateral development agency or the TBSA, just for argument's sake. We're saying that these entities ought to be rated similar to a sovereign, and therefore don't hold capital against them. If you don't hold that capital, you are able to lend more. So the rules for that purpose need to be changed. Let me stick to those three examples, but those are the types of things that we were advocating for.
Let's talk a little bit about equitable spread, if we can. How do you make sure that everyone, or as many organizations and individuals, are beneficiated as a result of this? And there's also the problem, I would imagine, of making sure that you bring in private investment, but you've got to make sure that they don't just cherry pick projects that are going to be profitable to them, that there is a wider and a more egalitarian spread, if you understand what I'm saying.
Yes. I think your question relates to the third of our recommendations. I think what you've got to do is you've got to make sure that the rules, including the procurement rules for entities, whether they be government or parastatals, that those procurement rules are friendly and do not give rise to burdensome processes on the one hand. And on the other hand, you make sure that they do not give rise to, let us call it, unproductive rents, corruption. That's the first thing you got to do. You got to make sure that the rules are clear, that they're not overly complicated, and that the procurement processes and rules do not result in rent seeking and unproductive rents. And we've got examples of all of that. I mean, if you just think about some of the East Asian countries, which have got rules about localization, but that localization is done in such a way that it is productive as opposed to causing corruption. The second set of things that you got to make sure of here is have platforms, in other words, IT systems and rules that make it easy for projects to pay SMEs quickly, rather than pay them over a period of 90 days, or in some cases 180, as we typically see in the public and in many cases the private sector. Have rules and IT systems in place that make sure that they get paid quickly, 30 days or less. Those are two examples I would give to you.
Tshabalala, let me pick you up on corruption. It has derailed the world over countless projects. How do you realistically propose to insulate new investment from graft? You just told me about the rules, better rules, more enforceable rules. What does that entail?
It entails, firstly, insisting that the red tape that is built up over years is reduced, firstly. Secondly, you make sure that procurement officers are ethical people and that they are monitored and held to account. Thirdly, that you have got separation of powers, segregation of duties in institutions and in projects between people who are making policy decisions, in this case, let's say politicians, and people involved in the procurement in those particular projects, that they're independent. Make sure that you've got clear rules of auditing, and that these things are independently audited. And in fact, before you even get to those projects, make sure that the projects will deliver against the policy prescripts that you put in place. In other words, there should be an evaluation, an environmental impact evaluation that tells you whether or not your projects are going to deliver against the policies that you have set. Once the projects are done, evaluate them at the end to check whether or not they've met the policy prescripts that you set. These rules, as it happens, Jeremy, already exist in the case of South Africa. We got the PFMA, the Public Finance Management Act, which has just been upgraded to make PPPs more efficient. Make sure that people are held to account. Make sure that they are monitored, they're evaluated, and when they've broken the rules, that they find themselves in orange overalls.
Here on Moneyweb, you're listening to Mandates and Megaphones in association with Standard Bank. I'm in conversation with the Group Chief Executive Officer, Tshabalala, who chairs the B20 Finance and Infrastructure Task Force. Sim, I want to talk about infrastructure delivery and capacity and also accountability and outcomes in just a moment. But as we continue this conversation, have you enjoyed the process, sitting and chairing this? What's it been like?
It's been an incredibly sophisticated process, I have to tell you. And I do.
You have to bring your intellectual A game to this, I would imagine.
Indeed.
Yeah.
And I have to take my hat off to South Africa Inc.
Yeah.
From the moment the process started in Cape Town, we had the first event in Cape Town. I arrived, I had the pleasure of flying into Cape Town, and I walked into the arrivals hall in Cape Town, and I heard German accents. I heard English accents. And the airport was abuzz. We went to the venue the following day where we had our meetings, and you had representatives from all over the world, all over the globe. And that event was world-class in terms of its organization and its content. And many people that were present at that opening event, Jeremy, remarked on the quality of the event, which bespoke or presaged the quality of the rest of the process, which I will speak to about just now. So really the A game, fantastic, front-footed conduct by South Africa Inc. Secondly, we had to then pick what are called knowledge partners in our task forces. In our case, it was Deloitte, the South African chapter of Deloitte. And then we also had network partners, in other words, people that help you with research, writing, networking. And in our case, it was Oliver Wyman and the International Institute of Finance, based in Washington. And so we had the best brains in financial services participating in our process. And I did tell you earlier on who are my co-chairs. That entailed 4 meetings with that group of people where we debated the issues that you and I have been teasing out. And we had to debate the balance between the South African perspective and the global perspective. But making sure that South Africa was influencing the outcomes. And I'm proud to say to you that we did. Again, the things you and I have spoken about found themselves into our recommendations, but they come from a peculiarly South African perspective. We had 170 task force members, people from throughout the globe. They participated in 4 meetings as well. Those people came from all over. They came from civil society, they came from business, they came from government, they came from development finance institutions. We also indeed had comments on our paper as we were drafting it from the IMF, from the World Bank, from the Africa Finance Corporation, from institutions in the United States, in China, in Australia. And pulling that all together, making sure that the 10,000 words in our paper, our recommendations, resulted in a 10,000 word document written in plain and simple English, but of profound significance, the impact of which will be pervasive and will last forever.
As we start to come to the end of this conversation, I do want to touch, we've spoken a lot about the financing side, but that's one hurdle I would suggest. Project execution is perhaps more critical if the money is there. Just very simply, how do you ensure that projects actually get built on time?
Well, you start off by making sure, and our recommendations say you must make sure that you've got project preparation facilities, because 90% of projects actually fail. 90% fail before you even get to the shovels. So make sure that you've got proper project preparation programs and that you've got funding for those project preparation processes. And then we need to reform the global infrastructure facility. So that you have increased funding and more flexibility, so that you get the money into these early stages of the projects. Then we're saying you've got to streamline. Remember, I made mention of the fact that you need less red tape to reduce rent seeking and corruption. Well, streamline regulatory and permitting processes for that purpose, but also just to make it easier to get these projects to delivery. Aligned to the World Trade Organization's agreement. Remember, we made the case that you need more multilateralism in this complicated world of ours, and increase the visibility and use of project pipelines. For example, there are 50 countries on the Global Infrastructure Hub. by 2030. So we want to get that to 50. At the moment, there are only about 25. So we're saying that 25 countries on this global infrastructure hub would like to get it to 50. That's a measurable thing to get these projects on the go. And yeah, make sure that we've got projects that are investable so that you can attract banks, insurance companies, people who are looking to invest in equity, and then also, of course, philanthropies, which provide some of the funding to these projects.
I'm also interested to know what role digital and green infrastructure plays in your recommendations.
They do indeed. So in Africa, our argument is simply this. Take East Africa. East Africa has got geothermal. The engineering is very easy. As Strive Masia said, you just dig a hole in the Rift Valley and that power just comes from you. So firstly, use that power. Secondly, use the knowledge, skill, and talent that is in East Africa. That part of the world has invested heavily in education, as a consequence of which they are attracting tech companies, and they lead the world in many aspects of digitization. And East Africa is adjacent to the copper belt. And data centers require vast amounts of copper. The wiring, for example, vast amounts of copper. Copper out of the copper belt is amongst the best in the world. So how about building the data centers in East Africa? Because it's close to the copper.
Makes sense.
It's close to the power. You're not going to use fossil fuels. You're going to use geothermal. And the two come together. The technology, the AI, the data centers that you are reading to, and green manufacturing, producing data on the African continent, using the continent's own resources, but building it on the continent.
Some
funded by Standard Bank.
Of course you're going to say that. Let me put a final question to you. This has been a very optimistic and bullish conversation, and I do respect that. But what accountability mechanisms exist or should exist to ensure that these recommendations, this magnificent document that you have produced, don't just gather dust?
Oh, no. Each of the recommendations have got clearly identified accountable institutions, and they've also got KPIs. So when I made reference to targeting 50 countries on the global infrastructure hub by 2030, that is up from 25. So it's 25 as at last year. That's a measurable thing. And there are accountable people that will help us to get there. The difference, however, so I've said that, yes, there'll be accountability, there are KPIs, we've argued for them. The world, however, doesn't have a world government where you can hold, or a world multinational where there's a chief executive, a governance committee, where people account and you hold them accountable. That we just don't have for this purpose. But I think the structure of the G20 and indeed the G7, the G20, B20, and the G7, when people agree on these things, they usually get acted upon. If the politicians get the stuff into their communiques, they make the commitments, they usually do happen. So our job is to advocate for them to do that. And frankly, Jeremy, this conversation is part of that process of advocacy.
And that's where I'm going to put a punctuation point. You've been listening to Mandates and Megaphones here on Moneyweb in association with Standard Bank. Our conversation with Tshabalala shows that unlocking finance and delivering infrastructure are not abstract policy debates. As you just heard, they're foundations of growth, jobs, and also competitiveness. So the B20 has made its recommendations, but their real value, I guess, is going to be judged by execution. And obviously, we will keep watching to see if capital capacity and political will align to turn those proposals into real projects. I'm Jeremy Maggs, and thank you so much for joining us.
Thank you for listening to Mandates and Megaphones. You can find more episodes on moneyweb.co.za.